good afternoon and welcome to today's session. Today is a continuation of last week. Last week we did internal capital project appraisal, modeling. Let me just show you what the topic was last week. Modeling NPV and IRR. Yeah, this was the topic last week. So at some point it looked as if I was cramming a lot into the 1 hour. But yes, it made sense for me to try and stop at somewhere that made sense, because if I just did it halfway, I don't think it would have made sense for those who will even watch the recording. So today what I'm doing is I'm going to now take it a bit further, but before taking it further, try to bring us up to speed with what we did last week in a slower way of explaining, so that those who watch or those who are not even around last week, they can also be able to benefit. So number one, let me give you the file in case you do not yet have the file. We shared it last week, but it doesn't cost me anything to share it again. So I want to get us the link for the file so you can be able to open it, you know, watch along. Something, okay. I was getting worried that actually something should pop up. That's modified, copy URL and go to Teams, and paste. So the practice along file. Okay, I think I should connect my second screen so that it makes it easy to. All right, so let me explain what we did last week. Sorry for the weird angle my face is turning to the camera. I want to connect my second projector so that I can be able to monitor the chat box at the same time as the session is ongoing. So you can use the opportunity to download the file right now in case you do not yet have the file. Good. Awesome. Let me drag this one onto a different screen. All right, so I hope you can still see my screen. I hope what I did have not knocked off my screen. This is the file.
Yes.
Shared it again. Thanks. I've shared it again in the message box. I see one person has joined us right now. Let me just repost it because Teams has a way of just restricting you to what was posted after you joined. Great, so you can download it and you have exactly what I am taking us through right now. So good. So with that done, I'm going to do a quick walk through what this is about. And when it comes to investment appraisal, remember the topic, internal capital project appraisal. So I told us last week that blackboard, whiteboard. So I have a whiteboard in my Excel. So good. I'm going to quickly again mention. So I told us last week, when it comes to companies' internal projects. So now internal projects, not internal projects that are related to expansion, that are related to internal, we call them internal capital projects. So this is not a project of, we want to do business development, or this is a project of either we are expanding and this expanding is of two types. So I would rather not just keep it as expanding. but as be very granular and say, okay, is it that we are expanding an existing product line, an existing product line or service offering, or we are adding a new product line. And for some companies, it can even be as big as creating a new subsidiary. So these are the types of internal projects that, in quotes, is classified as internal capital projects. The only reason you'll be doing this project is for financial return. As a company, if you're expanding your product line, the idea is that you get more revenue, and way better than if you put your money, if you had been keeping the extra cash you had in, I don't know, in treasury bills or whatever other things the company could have kept their money in. Then number two is if you are going to create a new product line, so you do beverages, right? And you decided you are going to go into hand sanitizer, which is exactly what 7-Up did, right? We all know 7-Up for Pepsi, 7-Up, Mirinda, but then there's hardly anywhere you go now, you will not see Too Sure hand sanitizer. They are the makers of Too Sure. So, you know, even I do not watch Nigeria, Big Brother Nigeria, but one of my staff, you know, kept mentioning that they were big on Big Brother, the one that happened during last year, that you keep seeing Too Sure adverts, right? What I'm trying to bring out is typically companies do this evaluation before they go heavily into. So for them to have gone heavily into creating Too Sure and pushing it that big, you know, big in such a way that they can meet the demand that it's generating. They must have created the capacity, they must have built that new product line, and before they spend all that money building it, they must have done an appraisal. So that's what we touched on. How then do you do an appraisal in an internal capital project appraisal? So there are many, like we say, there are many ways to the same market, you know, but here is one of the commonest way of evaluating an internal capital project. Okay, so this is a very common approach. If you come across like 20 different project appraisals modeling, you will find a lot of repeated patterns in what I have in there. You know, where we have a period start, something like this, and then you will have the project parameters. Let me just zoom this. Project parameters, and then those ones are pretty common. People have different ways of representing the other things, but those ones are pretty standard. Okay, so that's what we did. We said, okay, let us have in here different period. So this is 1 month period, but then if you look at it, I set it in such a way that you can switch it. You can say you want it to be quarterly, you know, so we did this last week, and you can say you want it to be annually. You know, in case you are curious about how we achieve this, you can download the file. I've already shared it, and you will look at the formula that is making all of that possible. But that's not the main focus right now. It's just to quickly brush us up on what it is I want to continue. Okay, so then the other very common thing is that for every factory, every product that you're going to create on large scale, there's going to be some kind of automation systems in place to create it in that huge volume that you need to push into the market, right? So for a manufacturing company, it's not uncommon for the production line to have its capacity. So this is something metric tons, something units of product. So the example we used last week, based on one of us suggestion, was to say this company is into toy creation. And then we decided to say, okay, the capacity of the factory is 200,000 units of toys. So that is what you are looking at here. We decided to say 200,000 units of toys is the factory capacity. But do you know that the company is going to first spend some time building the factory? So you can't just immediately start the factory and the factory start producing from day one, it's going to take time. So part of the project involves building. So you see there is a project approval date. So most times projects get approved before they start. Why? After approval is when the fund will be released. You start profiling the vendors, which contractor you're going to use, which third party people are going to help in setting up things, start hiring for the project. So it's never the same period that the project gets approved that it typically gets also commenced, like building will not commence exactly on the day of project approval. So you find out that the start date of building commenced, which in our own case, the start date also coincided with the construction date. It was like 2 months after, right? And then the construction of this particular facility was going to take 2 years. 2 years can be really long. You know, some companies might not require up to 2 years to set up their production line. Some might require more, but then it's always flexible. If you change this to 1 year, it's going to change. Your model is going to capture it, okay? So you will notice that the parts colored, for those who are just joining, the session is being recorded, but more importantly, this file that I'm walking us through is what we did last week. I'm going to share it so you can copy it because we want to continue from there. Okay, so I've shared it in the chat box. You can pick it up and then just explaining what we did the last time so that when we take it further, you will not be at a loss as what are we continuing. So the project, the expansion, the factory will have a capacity, then as usual, you can peg your projection based on capacity utilization. It's very common. So most companies have been exposed to their plan, capital projects plan. You know, they always have benchmark. So right from day one, you know, negotiated with the operations manager and all, they've estimated that, okay, we are starting this year, maybe we need to warm up the factory. So warming up might be like 1 month at very low production to get the engine synced, and you can run it almost like a car. If you buy a new car, or you know, they write it in the manual, you shouldn't rev it too high, you know, because it's new. So the same thing too with most of this factory stuff. You can't just start it from day one and move it to the highest production level. So they might say you have to stagger the capacity utilization. So, you know, but then management will say the plan is to reach 50% utilization in 7 or 6 months. And then with that plan, they do their hiring plan. With that, they begin to push, know how many sales people, sales partnership, maybe negotiation with off-takers. You know, there's a whole lot that ties together 3 sides of the people. The company management who's going to approve and provide the capital funding, the operations, the project people, you know, the technical side of it, the productions manager, the technical project manager, the on-the-ground guys who are going to determine, you know, how much resources they will need, you know, how much production officers, factory workers will be needed to meet the production level that they are planning towards. And then there's going to be also the demand side. So as you are supplying, producing, you can't just produce and be producing if the products are not being sold, right? So right from day one, they begin to negotiate with, if it's a product that is B2B product, they begin to speak with other companies who will buy, like you can call it off-takers. And if it's a mass market product, they begin to do a marketing even ahead before the product is ready for sale, so that people are aware. They negotiate, they begin to work out how they will have different warehouses in different places. So these things I'm saying, even though we are doing them, you know, abstract on paper, they're exactly reality. So it's not, you know, it's not like this is a purely academic exercise. It's something that it's commonly done. And so this is just explaining the factory capacity utilization. It's a very common thing to tie plans around the capacity utilization. And then here is where things can be grossly different. Okay, so for some companies, they might just, for them, they might use margin. So they could say, okay, we're just going to, whatever we produce at, we're going to mark it up 40%. We're going to, so people do margin in pricing. Some other people decide that they're going to go and check out in the market what the product are selling. So they're going to try to standardize their product to have very similar, to be similar to what's already been produced. Imagine if you're going to produce Coca-Cola kind of soft beverages. You're not going to go and produce your own at 20 CL, 70 CL, you know, because it's going to be very difficult for you to know the right price. But then when you produce a similar already existing product sizes, we already know 50 CL or exist. Nobody drinks 35 CL anymore, but we know 1 liter exists also too. So you produce at that one and then check, go to the market and say, what are they selling at? And then use that to be your selling price. So this is the one where I see different methods, not the unit cost. Unit cost, you will always know, right? Or there's one flat line. You can't use different approaches for unit cost. But this price, unit price, it can be based on what the market is selling at, what the market price, comparable market price is for your product, or you are going to do it in such a way that it will be slightly distinct, and then you can set your own price, have it as a markup, okay? So whichever is applicable in the kind of company or service you are producing. And then there's going to be the volume, how much you are pushing out per period. So how much you are. So you will notice that for the construction period, we will not be able to produce anything. So construction is going to last 2 years. So up until December 2023, the business is not going to be producing anything because the factory is just being fitted or completed. But then right from 2024, you see that production begins to come online, okay? So then production starts and you'll be like, so in a training we had, you know, someone was like, we don't plan to shut the factory. Why do we need to put an operations end date? So the thing is, no plant runs for life forever. You know, a plant always have a lifespan, okay? So it's now left for you to decide to want to continue after, right? Even if you know you're going to continue after, it will not be the same plant. You will have to replace the plant. So when I was in the telecom space, they used to call these things phases. So you will see, they will say, oh, this is phase 1, 5 years, and the years are normally tied to the lifespan of the facility. So because they know they're going to have to replace the facility in the next 5 years, so when they award to maybe Ericsson or Huawei, they always make it as a phase. So they could say phase 1, you know, and then when the whole 5 years is over, is because the industry is not static. They want to upgrade to the next. So they will invite other vendors. Everybody will bid for the next phase, bid based on your new technology that you have, how competitive, how easy it is for them to cut over to your own technology. So there are many approaches that is being done, even for companies that are typical manufacturing companies to some factor it in and they call things in phases. So they'll say phase 1, you know, and blah, blah. But the key thing is the plant you are setting up will not be there for life. So that's why when you're doing the capital project appraiser, you want to put the years of operations. But if it's real estate or some things that will not die in 10 years. So typically the approach is to say, let me look at those who are here so I don't say some things that are confidential. Let me just take a peep at our names. Okay, great. So there's a company that I had to do something for. They're into real estate. They're into real estate development. Okay, so if you have a property in Ikoyi, in VI, all those places where, you know, property prices are crazy high. So if you have a bungalow, you know, you have a bungalow on Alfred Rewan Road, a bungalow at, you know, Lekki Phase 1, a bungalow around that 4 point. In fact, one of the ones they were doing were around that 4 point Sheraton in Lekki side. Okay, so what they do is they will come and meet you, you know, they'll come and meet the family and say, you know what, instead of you having a bungalow, you know, what if we demolish this your bungalow, we put a 20-story or a 10-story commercial building there, and we're not buying the land off you, and we are going to, sometimes they might say they'll give you a flat. So if it's a 20 flat building, they will permanently give you a flat. The land is still yours. It's not like they've taken over your land. They have ways to structure it. If on the mainland, some of the things are even here is for commercial, for residential houses. They could come and maybe your dad has a land and a house, and somehow the house is looking old style, and then the environment, that locality has really boomed. They could come over and say they're going to demolish the house or remodel the house, make it have a bit more modern looking, create more flats, and then they will say, you know what, they will give you a flat, maybe out of the 5 flats, but then after 20 years or after some years, everything belongs to you, So there are different models, but these guys don't do the one everything belongs to you because they spend a lot of money on it. But the key thing I want to bring out is, we all know that the building is not going to die after 10 years. So how do they do their own? So they too use 10 years because I saw the model. Right? But they do what we call terminal value. So when they raise money for these capital projects, because they actually raise money, right? So they will tell you, the investors, your money is going to be locked for 10 years. So they time their model to the exit period. So the exit period is that when we raise money from different investors, they usually raise money outside of the country, in Europe actually. So they're going to say, okay, we are raising this money as a 10-year something fund, 10-year ABC luxury real estate project or fund. Your money is going to be locked in for 10 years. And so when they are doing their model, they are actually also matching the timing. So what they do is what we call terminal value. So at the end of the 10 years, they use an exit multiple. But we are not going to talk about that one. I'm just trying to explain that, yes, there are other ways where you cannot actually say the business or the thing will die in 10 or 15 years, but still, you still always have to have an end date for your model for those capital projects. Okay, if there are any questions, please feel free to interrupt. So that was what we did. We did our own to be like 10 years operation for the plant, which means operations we end in after that 10 years, and automatically the project will end there. There are some projects that the operations end date and project end date are not the same. In mining space, imagine you set up so we did a model for someone in gold mining, right? A financial model. So for them in that space, the mine has a useful lifespan. So maybe the estimated lifespan or the estimated reserve or whatever it is they call it. I know oil and gas now is called reserve. Maybe the estimated quantity in that location is something that with the rate you are going to mine will be over in 20 years. Okay, so you guys are mining gold or lead, you are digging into the ground, that place you are practically spoiling that place, So after the whole 20 years, right, which our model will say your operations will end in 20 years, you've mined everything. You cannot just go away. Project cannot just end like that. You have to decommission the mine. You have to begin to reclaim the land, make it back to something that will be fit for another purpose. Government normally will not let you just carry away your equipment and leave all those huge holes you dug everywhere. Okay, which is funny because the place I used to live, that was what happened. So some people mined like what they use in producing cement and all in that place, and because they did not do this decommissioning properly, you now see like a huge cliff, like you in this street, your land is very high. Then the next street is as if, I don't know, you will know it's somebody that dug it, but it's so different that you can build a one-story building on the other street and it will be on the same height as the floor of this our own street. We were on the high side, but so it was because some people mined that place many years ago and they did not bother to do a proper decommissioning and blah blah. So great, now that one is explained. I've explained, you break it down to what you're producing. If you're producing multiple products, then you break them down into those multiple products. And then you break down also the operating expenses. So pre-production, your expenses might be smaller. You know, when you are constructing, you will not have factory workers, you will not have so many expenses compared to when production is on stream. So you find out at the moment we started producing, the expenses jumped up. You know, starting from the first period of production, expenses jumped up. Okay, so that's a very normal thing. And then capital expenses. So for the capital expenses, usually from capital project, the bulk of the expenses happen on the first year when you are starting the project. So that's where you pay for the building, the plant and machinery, the equipment. Depending on how the project is like, you might have to do some furniture and fitting. Some you might not do in the first year. It might be until when the factory is set up before you now start doing some of the furniture and fitting. But nonetheless, the pattern is always the bigger chunk of the expenses come up in the first year, and then gradually the other expenses might start popping in later. So you see that after the production is done, we have to buy more vehicles for the marketers, for the operation staffs, and some more equipment, and then maybe expand the office area with more furniture and fittings, blah blah. And then I didn't even drive this properly. Usually the project should be able to pay its own tax. You know, you should be able to factor out the operating profit after tax, no net operating profit after tax, no part. So that's this no part, net operating profit after tax, is the equivalent of the net profit, net operating profit after tax. Okay, so good. That's what we will be able to get, and this is the model itself. So for those who just joined again, let me repost the link of the file so that you can be able to also walk along as I'm explaining. So let me just take a look at my time. Okay, I need to wrap up in the next 2 minutes the explanation so we can do the phase 2. All right, so with those information in sheet 1, we are able to easily get out the revenue, which is going to be unit price times quantity. So volume and price. So volume and price. This gives us our unit price, our revenue, and this one gives us our cost of goods sold. Okay, so with those two, we're able to compute the profit, and then gross margin, we are able to also get out the operating expenses, that's this portion. Okay, and we're able to also calculate the operating profits, you know, and get out the operating profit margin. Because we are not financing with external debt, and we are not saying the business, the profit from here is going to be specially saved in an interest-bearing account. No, so that's why we are not putting anything in the finance income and costs. Then we have the profit after tax, the net income, which I've explained is like net operating profit after tax. Okay, then the net margin. So these are now what we use in estimating the cash flow from the project. So what is this project cash flow? Even if you want to set up a project like you want to do a fish farm, you want to do something where you're not looking to do a full financial model. You're not interested in creating a balance sheet. You just want to see what's the cash profile, cash flows going to be like. Then you can use this approach too. You're just going to say, okay, how much is it going to cost us to build the fish farm or whatever it is? You know, how much is going to set up? You know, how much are we going to spend? You know, how much are we going to buy the fingerlings and feed them until they are big enough to sell? How much are we going to sell at? How much quantity we're going to have? You know, you have to pay tax. So then you put the tax, you know, and then voila, we are here too, you know. So it's very similar. So because you don't care about balance sheets, it's not like you are trying to do a full financial company model. then this approach also works. So this works a lot for, even as a person, projects you want to embark on, maybe joint with somebody else, and you guys are wanting to just do it on a not too big deal. You are not going to use external funding. You are not going to, you just want to see the profile instantly without having to do a very complex model. This also suffices, okay? So with that, you're able to see what is the cash coming from the business. So the assumption is that there are no receivables, no payables. So nobody, all the sales you make, the cash will come in. All these procurement you make, you pay instantly in cash. So that's what makes it different from the full financial model. In the full financial model, you have to do balance sheet and factor in for accruals. But in this one, no. So this is more like you're doing a project finance one where you're just basically basically forecasting as if the money that's going to come in is cash, the expenses are also cash based. So that's why the cash from operations is going to be exactly your net income. Okay. There's no adjusting for non-cash item, move changes in working capital. Then cash from investing is simply your capex spend. Okay. Then cash from financing. So in this case that we are not borrowing. So for us that we are not borrowing, it's very easy to say, yes, we are not taking any loans. And then because usually for internal capital projects, is the company's own resources. So the whole money is going to come from the company. And so that's why we are just not worried about that. We are not, if you want, you can say it's equity, but it's really not equity. So in this case, we are just leaving out all the equity side of things and just saying, are we taking loan? If you're not taking loan, then perfect. So what that means is that for you as the company or the person funding the project, right, this is the cash pattern, the cash flow pattern. You're going to have to first spend, what is this now? 1.312 billion. Yeah, 1.3 billion naira, and you keep spending because in the first couple of, in the first 24 months when you are building and you are not producing and selling, it's coming out of your pockets. It's like your, that's what some people call working capital. Oh, you start a business, the first 6 months, you have to pay salary out of pocket, you have to pay rent out of pocket before the business starts generating enough money to cover that. But in this case, it's much more than that because you will be spending for the next 2 years, okay? And before you start getting money back to start sustaining the business. So that's the net cash flow. That is what we are going to use to calculate the internal rate of return. So we did that, if you see, we did that last week. So that's what you're going to spend at the beginning and how your money is going to come back to you over the lifespan of that project. So we did that. And then we also did the cumulative cash flow to help us determine the break-even point. So cumulative is cumulatively what are you spending or getting back. So you see it's the what you spent the last period plus what came back this period. So break-even is when that is 0. So that was how we were able to find out break-even at what was it? So we broke even at this period, which is it's actually May. Yeah, May. So it's May 2025 was the break-even, and that's like 3 years, 5 months. Okay, so you might need to correct that in your own. So then we did the expected. So this is the part where part 2 actually starts. Okay, so I'm going to wipe off this place because when I got here was when I started rushing things and then it became a decision of I need to redo this or continue it this week. So up until here, pretty much everybody got it. I can even redo this part too in case anybody, just, it's not difficult. So if you are going to spend, if you are going to build a fish farm and you spend 50 million naira upfront and you keep spending 10 million naira every year to keep the farm running before you start selling your first produce, then this is how the thing is. But in this case, we are spending monthly. So this is a monthly profile, right? So if I'm doing my internal rate of return, IRR, again, for those who are familiar with IRR, you will know that, yes, there are different versions. There's MIR, XIR. I don't want us to go into that debate, you know. Let us just use this IRR as it is, and then look at what is the internal rate of return. This business, internally, what return am I getting out of this business? I'm spending 50 million naira upfront, and this is the cash pattern. You know, I'm spending upfront. Next year I'm spending, but the year after that I start getting profit. So with that, I select all of this, the whole money to the end of the period. Yeah, to the end of the period, and then I say, okay, right? So it tells me that I'm getting 4% monthly return. So I need to take this to a yearly, because most of the times, most other opportunities you have are pegged on an annual rate. So it always makes sense to change whatever rates that you are getting to normalize to a yearly one. So taking it to a year, it can be roughly done by taking the monthly multiplied by 12%, 12. So it shows that, good, that means this is actually 3 point something. Oh. 12 times, oh, okay, yeah. So it shows that that this is the annual rate, which is not bad. You know, if you get a business that is going to give you 52%, that's a very, very good business, okay? So the other thing that we did last week was we said, what about you? What is your own cost of capital? What is your own expected return? So this is where I want to quickly explain the concept of expected return. So every person that wants to go into a project, be it a company, be it an individual, you have opportunity costs. Or you have alternatives. Let me just use this is the English for that. You have alternatives, right? So this is how we calculate what you should expect, right? So this is the way we come about the alternatives. Number one is everybody has what we call a risk-free alternative. The risk-free alternative is popularly taken to be the government bonds, which in Nigeria, you know, you can just look at the Treasury FGM bonds. For a project that is going to be a 10-year project, you could take the comparable or a risk-free alternative to be the 10-year bond, okay? So if I can get 10%, right? This is 10% that you as a company or as a person, you can forget about the money when you put it there and you go about your life. You know, your blood pressure is not going to be going up and down, right? So that is why we call it risk-free rate, okay? And in case some people argue that, oh, government can defund or is not really risk-free, the thing is that it is typically assumed that the government will never default on its local currency bonds because they own the printing press. They can always print money. They can only default on the foreign currency one. I don't think there's any record of a government that defaulted on their local one. So this risk-free rate, right? In addition to that, so any business you are going into, you don't want it to give you less than this alternative, right? So you are going to now say plus a premium. So this premium that you're going to demand, we can call it's called a risk premium. For me to take this risk off, rather than putting the money in federal government bond, you know, rather as a company, we just putting the money in FGN bonds, We want to use this money to go into a new product line, create a new subsidiary. Then we are going to demand a premium. It will take us more stress. We'll start monitoring. There's a whole lot of stress attached to it and risks attached to it, right? So for it to make sense for us, then it has to give us better than this 10%, right? So how do we typically evaluate this risk premium? That's where everything goes into subjective. The risk-free rate, objective. Everybody agrees on that methodology. When it comes to premium, there are all kinds of approaches. You know, there is a CAPM, capital assets pricing model. There is the APT. There is the APT, arbitrage pricing theory. There, Farmer French, there are a whole host, you know, of different approaches, but the thing is, they can all be encapsulated in this. So there is what we can call the almighty formula for risk, the almighty formula for risk, formula for risk premium. Okay, and that formula says that, you know, for your expected return, you know, the return you're expecting, we usually use small r for expected return. Expected return. Let me just use the eraser. So for your expected return, right, it's going to be equal to the risk-free rate, which, like I told you, nobody to be down. There is not too much controversy around it, you know, except if you just like to be arguing. And the funny thing is, if you argue it, you don't have a better alternative, because that's just still your best option. Okay, so the risk-free rate plus so the almighty formula says that normally we use the Greek letter alpha, beta, but I don't even know all the letters. So let me just be using ABC. So risk coefficient A for risk factor 1, B for risk factor 2, C for risk factor 3, D for risk factor 4, and as many factors as you want to consider, right? So that's where you will hear things like single factor models, single factor risk models, multi-factor risk models. This CAPM is a single factor risk model. That's why most people do not like it. Let me use that word. Unfortunately, it is the most transparent. Yeah, it's transparent. The word easy to explain. Let me use the word easy to explain. These other ones can be like a black box, right? So most of the time, most APT are, you know, Farmer French. There are many approach, you know, depending on the industry you are trying to go into. So let me explain how this works. What are the risk factors? So there is what we call the there's the market risk. What is market risk? Market risk is like what happened last year, the COVID-19 issue, right? Everybody was affected like it was general. It's as if when they say rain is falling in the whole of Ikeja, then if you're in Ikeja, the rain is falling definitely on you, right? So it's something like that, you know. It affects everybody. Nobody was smart enough to avoid it. Yes, that's why they call you risk. Risk is like a up and down, right? So for some people, it might push their own up, but some people it will push them down, but hardly anybody will it be neutral for, okay? So there is market risk. So we can call that RM, okay? Then this is a market risk. Sometimes we call it idiosyncratic risk. That is the risk you cannot diversify away. There's no way you can diversify that risk. It's just what is the word to use now? It's just what's present for everybody, okay? Then you now have other risks. You could have political risks, depending on, so if you are doing a business in Nigeria, you know, obviously there's Buhari risk. Or whatever, like, government risk is the right word, let me not say, because it's not even Buhari that makes all those bans. That's the thing. You know, CBN tomorrow can come up and say blah blah. Another Nigerian broadcasting company can, you know, everybody is just trying to see how they can give other people headache, you know. There is all kinds of risk that deals with the nature of the business you are in. So if you are in a business where you are exposed to FX, so you are going to have FX risk, FX volatility risks. You know, we can call that RFX. So the key thing is, for you, you want to identify what are the risk factors that you are exposed to in that your own business, and then you will create a formula to give different weighting. So market risk, you might be the coefficient of volatility, which usually is called beta for market risk, you know, which is equal to the variance of your own return over the covariance with the market. Let me just show us that. I'm beginning to say things that are theoretical, but the interesting thing is you don't need to do all the calculation from first principle. Beta formula. So it's variance over covariance. Where is that? See, oh, it's the other way around. It's the covariance over the variance. So how your business varies with the market over the variance of your business. So for other risk too, that's where everything is a black box. Apart from beta, that because it's tied to CAPM, there is a way to defend it. All these other ones, you put your own factor. You can say you want to give a political risk a weighting of I don't know, you want to give it a weighting of 10%. You want to give this other one a weighting of 5%. So that's why these multi-risk factors are like black boxes that it's very difficult to explain it. When you use it, you have to now defend with stories, unlike CAPM that you can use and everybody can go and check and see whether what you use, you know, is correct or wrong. So back to all what we are trying to explain here, which is the expected market return. How then do you come to your expected market return? The expected market return, you know, the expected return, I mean, that you want is, so let's say I'm producing toys, right? Because that's what we used yesterday. Toy Limited. What are our risks? Obviously, if I'm going to go into this toy business, or if I'm asking for your money, you expect that you get more than the 10% federal government bonds, right? So that 10%, I must give you more than that. Then let's say all the companies that are into the, first of all, let's say the markets, the stock markets, for a long time has been returning 16%, which means people who go and invest in equity, they expect 16% market return. So that is RM. Long-term market return, 16%. But now, because we are calculating the risk premium, so that means it is 16% minus the 10% of the market of the risk-free rate, so that's 6%. So that's the risk premium everybody is demanding. They are demanding a 6% risk premium for putting their money in the stock exchange. Now, your own company, how does it, what's the beta? How does your company, how does your industry, go in tandem with the market? Is it more volatile? Is it less volatile? That's where the beta comes in. So let's say maybe your business is going to have the same profile as the general market, right? So you could say, that's the beta, or, well, let me leave it as beta. So you could say your own beta is 1. Your beta could be a different value. Let's take a look at a company on the stock exchange. Can somebody give me a company that you want me to, that is on the stock exchange? I should get you the beta for the company. Any suggestion? Going 1, going 2. Okay.
Okomu Oil.
All right, good. Okomu Oil. Okomu Oil shares. So the beta is a very publicly available information for publicly traded companies. So that's why I can go online like this, and I can click on some of the results I will see, and I bet you will see, except these guys, Bloomberg, they are too profit driven, so you might not see the information there. That's why I skipped it, because I usually don't see the beta, the stock, before they used to show it. But can you see 0.724, right? So it's a freely available information. There might be some variances on different people's platform because of the way it's calculated, but it will always be very similar. This is trading economics. They did not calculate the beta. The other one, investing.com, we have it. Let me look for. Whoa, 0.44. This gap is too much. Somebody is doing something wrong. Let me look for another result somewhere. Then we compare, because that gap is not supposed to be that different. Otherwise, I can show you how we calculate it. It's not difficult to calculate. That's the funny thing. Well, that's the good news. Beta. These guys have stopped publishing the beta. That's why they want me to pay now. I'm not paying for anything. I would trust FT over trading, over investing.com, but I just want a tiebreaker. Well, let's see if we can calculate it ourselves. Let me check the time. 6 more minutes. No, I'm not calculating myself. It has a formula. You said that variance covariance. That's the formula. If I just get the prices of the stocks, which you can get if you have my app, Nigerian market data, so you can get the price history of Okomu Oil. Let me just. You can just type Okomu. And if I select this, okay, I think I didn't get the name correctly. Let me get the name out. So Okomu Oil. Filter. And I type Okomu Oil. So the ticker is Okomu Oil. Okomu Oil is the ticker. So that's what I got from. If I put it here and I go to my stock app and I say, do you know, get me the price of Okomu as far back as, I don't know, to do, 1 year is enough anyway. So I think I've set it to do 1 year. Good. So once I get this, then I need to do the ASI, or share index. ASI, I do that one too. Good. So that one too, 1 year. Good. So it's now that these two figures that we are going to put side by side. So this one is the ASI, and this one is the Okomu oil. Good. So if I want to calculate the beta now, all I have to do is remember the formula, covariance over variance. You can go and confirm that again. I still have that page open. See? So the covariance over variance. So let's do the covariance. Covariance sample size. So of the security I'm interested in against the general market. Pick one, pick two. Then the variance of the market. So the variance of the market. Variance sample of the market. Good. So it's equal to this one divided by this one. That's, the gap is really too much. Apologies. I forgot to do the returns. It's the returns that we are doing for ASI return, Okomu return. So today's return is equal to today's price divided by, if you know, return is today's gain, which is today. I should have even just copied the gain. It's actually there instead of calculating it all over. Gain is here, price change, but not a problem. We can just calculate it once and for all. This divided by this minus 1. I'm going to copy this, paste here. Then I have to delete the last line. Good. So this, my covariance is actually this against this, and this one is actually this. Even what I got is looking very different, but that's the formula, right? But like I said, you can always grab it from the web. I'm just surprised why everything we are getting is really different. Let me pick another company that is very common. So let's just say maybe because this is not so common, maybe the price doesn't change too often and is affecting the computation. Because when the price of the stock doesn't change too often, then it brings about this kind of issue of difficult to for Dangote Cement, beta 1.151. Let's go to another provider. See, so this is what actually I'm expecting. They should be close. This is 1.15. So when they are too far apart, I'm worried because which one will I pick? So at least you've seen that is information. Now when I see this one, I'm okay to using it. So to round up, right? What we are saying is that you as an investor, if you know the beta of the opportunity, so if we use the Dangote one now, and you can use proxy. If you don't have a company, if your company is not in the market, we use something similar. So based on what we said, we are into toys. So if we know that FX is another big factor for us, we can do another one around FX and say, okay, is this what they call gamma? So gamma FX, what's the amount of weight we want to put for FX, then you can do another one, alpha, maybe political risk. So that's why this one is debatable. There is no formula, there's no way you go and grab. You are the one who is going to just do your own internal computation and have it somewhere to defend. But essentially, if you're an investor, the common CAPM says, this is CAPM. This one you're seeing here is CAPM. It just says single factor, which is your expected return is equal to risk-free rates, plus beta into total market return minus RF. So which is like what we did here. You remember I did this minus this, right? But then if you are very serious, you might want to do something more to capture other factors. So whatever it comes to, if you feel for you this investment, if we do that one for Dangote, if your business is cement related, so that would be, let's say 10% plus 1.15. We've said stock market is giving long term 16% plus 10%. So if I do this, that's equal to 10%, 1.15 times 6%, which is the, so if you do this, 1.15, I'm using a calculator now because it will be faster for me. 1.15 times 6%, that's 6.9. So this is equal to 10% plus 6.9%. So if you are going into that business, then automatically you will say your cost of capital, your expected return is 16.9%. So if you do this, so doing that, we are able to know that our expected return is 16.9%. And with that information, we can be able to calculate what is our net present value. So using that information, we can say, okay, what's the net present value, NPV, our expected rates of return, and then what the business is giving us. So this is the return profile of the business. By the time I do this and I do enter, right? So it's, we've again made a mistake. This is annual. So I should have divided it by 12 to get it into months. Good. So this should be, that's what we should use here. So on the monthly rates, it should be So it's telling us that this is a profitable business. So if your expected rate of return is 16.9 annual return, then this is a very good business. You're going to get superior returns above your own expectation. But if the business, for instance now, if we have said our expected return rate is 52, this now, if I said this is our expected return rate, you see this will come to 0, right? So what net present value is showing you is that if the business is going to give you less than your own expected, if the internal rate of return is less than your expected return, you will get a minus. What do I mean? If you are the kind of people that expect to double your money every year, 100% is what you're expecting, then you see that this is going to be a negative. That means this business is not up to, it can't give you that amount. So that's why your net present value is minus. And if you're the person who you're expecting exactly the same thing as what the project internally generates, it tells you 0. So you're not getting any superior, you're not making profit or loss kind of. You're getting exactly what you expect, right? And if you're expecting, like what we said, 16.9, then this is a superior profit project. So you would rather jump on this project because you get superior return. So typically, people expect positive value. Why? Because it gives you room of margin. We call it margin of error or margin of safety, I mean. So the bigger the net present value, the more room that you have in case your plans didn't work out well. You know that, well, you already had something higher than what you expected, you know. So that's the end of our session today. Any questions before I wrap up the entire session today? Any questions? So if you have no questions, thank you for joining, and do not forget, for all your training needs, you know, we are there for you. And if you want more tutorials, we even have a dedicated section for tutorials on our site, and you can access free tutorials. So as you are here on financial modeling, we have on Power BI, and we also have on Excel. So on financial modeling, you see a lot of videos, you know, around different things. That's, you know, even a video on doing a financial model from scratch. And if you're interested in Power BI too, we have a whole lot of tutorials around Power BI and for Excel too. So we make things easy for people to have a taste before they even come, you know, so you can see what it is the content are like. So feel free to refer us to people, you know, and check us out for your training needs. So thank you and have a nice Sunday. Okay, I should also let you know by 4 p.m. we have another session where we have a special guest. We have, I think, someone from, I can't remember the country. So please, if you're interested in improving your Excel, you know, data storytelling tips by Caroline Ferreira. I'm not able to pronounce the name very well. Well, you know, if you're interested, then yes, by all means, join us. This is the joining link. You know, and if you're interested in Power BI one that way, so this one is for 4 p.m. Then if you're interested in the one that will be Power BI, so the person from Morocco is still the person we have today, Salif. So that would be also cool. You know, you can join us, but today he's going to do Power BI. So he's taking us through cleaning data with Power Query. So if you're interested in that one too, let me just drop the link for you. Power BI session at 6 p.m. Yeah. So thank you once again, and have a nice rest of the day and a good week ahead. Bye bye.